Happy Tuesday out there, folks. This is Darius Dale here to present our macro minute for Tuesday, August 30th, 2022. Starting with asset markets, we have stocks up this morning, commodities down, crypto up, dollar down, global bond yields mixed. Market moving headlines. So the ECB's inflation headache intensifies. Inflation dominates in Europe this morning as Germany's headline number accelerated to a record 8.8% year over year in August. Spanish CPI eased for the first time in 4 months, though it's still in double-digit territory for the third consecutive month at 10.3% year over year. The ECB meets on September 8th. That's next Thursday. Markets are split on a 50 to 75 basis point hike. I think they lean 75. And the reason I say that is because it's very clear that the Eurozone, the Euro region, has arguably the clearest path towards recession, towards an actual recession across all the major economies. And so it may be the case that they want to front load rate hikes into that because the longer they drag their foot, the less likely it is they'll be able to follow through with the kind of policy tightening they need to promote their price stability mandate. Secondarily, you have excess demand continues to complicate global supply chain. So Taiwan Semiconductor warned that penny chip shortages, I didn't even know what that meant till today, are hurting the semiconductor industry as its legacy factors struggle to meet demand. Let me say that again. Taiwan Semiconductor warned penny chip shortages are hurting the semiconductor industry as its legacy factories struggle to meet demand. CEO CC Wei gave one example. A 50% radio chip is holding up production of $50,000 cars. Taiwan Semiconductor is building new factories to relieve pressure, but he said, quote, the age of an efficient, globalized supply system has passed. I definitely take his word for it. This is one of the most important companies in all of the global economy, Taiwan Semiconductor, selling chips to basically anything that sells anything with electronics in it. So we definitely want to call that out in terms of the global supply chains. We've seen a tremendous amount of easing global supply chain disruptions, but very clearly we're not going back to the fully globalized, kind of on-demand kind of world that we lived in prior to the pandemic. Big movers this morning, having some fading in commodity markets this morning. Bloomberg Agriculture Index down 1% to up 3% month over month. Bloomberg Industrial Metals Index down 2% to down 2% month over month. And then WTI crude oil haven't taken a breather here, -3% to -2% month over month. Taking it to the charts today, just before we even get into our volatility, adjusted momentum signals and probable ranges, I have a couple charts today because this Taiwan semiconductor news really kind of it triggered me, so allowed me to be triggered. So the title of the slide says, supply chain disruptions are what happens when you flood the economy with income during a period of depressed production. So one thing that's really, and part of my language, has chapped my ass for the better part of 18 months is this nonsensical claim. And yes, I'm talking to you. If you believe this, it is nonsensical that it's quote unquote supply chain disruptions causing all the inflation. There's a view out there amongst the transitory community that, hey, look, the Fed can't drill for oil, Fed can't plant crops, Fed can't ship things, and therefore the Fed must sit on his hands to combat inflation. For a variety of reasons, that view is asinine, not the least of which every single time we've had an inflation episode here in the U.S. economy, it was coincided with supply chain disruptions and a very tight labor market, two things we currently have today. But that's neither here nor there. The point I'm trying to make with data is showing you the excess growth in gross national income relative to gross domestic product. So this is quarterly data out of the U.S. economy, taking it all the way back as far back as we can get the data that we do it at 42 Macro, understand the full distribution of the time series. And what you could see in this post-pandemic era very clearly is a widening spread opening up between gross domestic income relative to gross domestic products, the stuff we make, goods and services we produce. We got paid a crap ton of money to produce nothing. And that's exactly what the fiscal stimulus, basically handing out trillions of dollars worth of checks, both in PPP loans, et cetera, obviously, and STEMI checks, et cetera, throughout the pandemic. And now at nearly $1 trillion of a spread, we're clearly in the 100th percentile of this spread between gross domestic income relative to gross domestic product. Well, obviously, the smart folks watching us are going to say, well, Darius, it's all nominal. So what does that even mean? I'll say, aha. Let's look at it on a ratio basis. And so on a ratio basis, we're at 1.04. It's, historically the mean, as you can see, the mean of this time series is 1. These things should roughly equal out over the long-term time horizon. Clearly, there's fluctuations in various parts of the business cycle, but the mean is 1. As you can see, however, on a ratio basis, gross domestic income is at an all-time high relative to gross domestic product. And so these two charts, in my opinion, really kind of they challenge the nonsensical claim that it's supply chain disruptions, causing a lot of the inflation to a duel. The only reason supply chains were disrupted is because we handed out trillions of dollars and created trillions of dollars of excess demands. If we did not create those trillions of dollars of excess demand, then supply chains would have been just fine to handle the traditional workload of 2019 levels of demand. We created 2022 levels of uber stimulated demand on top of less than 2019 levels of productive capacity across the global goods and services sector. So just wanted to bang that home. Tweet at me, challenge me. Definitely don't challenge me in a lack of data. I don't have any time to hear anybody's conjectures or narratives. This is a data-driven firm. This is a data-driven program, and we're going to stick to that. So let's move on. Looking at our volatility adjusted momentum signals and probable ranges. U.S. dollar index, that is bullish fam, still fading from the upper bound of its probable range. You got about 1% of downside versus 1.6% of upside. Gold bearish fams. Finally in a position to make a higher low here. We'll see. We wrote about that in the early the leadoff morning notes, so definitely go check that out. 10-year nominal treasury yield breaking out to bullish fams today. So last week we saw the 10-year German bond yield break back to bullish fams, the 30-year nominal treasury yield break back to bullish fams, and then now we have the fall through the 10-year nominal treasury yield breaking back to bullish fams. We're seeing a resumption in fixed income volatility as the Fed really starts to push us further into what we've been talking about, which is phase 3 of the U.S. monetary policy regime. So definitely keep your eyes on this. Will we see new highs in the 10-year? Perhaps over the next few months, particularly if the inflation data misbehaves in basically a repudiation of what we saw in terms of it behaving in the month of July. High yield credit spreads, bullish fams, those are overbought. S&P 500 bullish fams, that's oversold. VIX bearish fams, that's overbought. NASDAQ 100 bullish fams, that's oversold. Russell 2000 bullish fams, that is also oversold. Bitcoin bearish fams, 5% downside, 9% upside. Ethereum bearish fams. Merge ain't helping this last couple of weeks here. Minus basically a fair fight, minus 13% of downside versus 11% of upside. Shanghai Composite bullish fams, that's still oversold. WTI neutral fams, that's in the middle of its range there. Ag bearish fams still overbought in the context of that down move today. And then lastly, industrial metals bearish fams, kind of a fair fight there for the first time in a while. 4% upside, 3% downside. So with that, Darius Dale presenting our macro minute for Tuesday, August 30th, 2022. And if you like my data-driven rants, we got our macro scouting report for the month of September coming out next Tuesday, somewhere between 100 and 125-ish slides of data-driven rent to help you set up your portfolio from an asset allocation and portfolio construction perspective to take advantage of the kind of critical macro developments that we see coming down the pike this fall and this winter. So definitely check that out. I think it's probably the best priced institutional product on global Wall Street. If you have a different view on that, tweet at me. We'll definitely have a discussion. Cheers.